Welcome back. You're still tuned into MF Corner. Let's welcome Hemant Rustagi, the Chief Executive Officer at Wiseinvest, to talk about investing in value funds and growth funds, because we've been talking about premium valuations, this sharp run-up that we've seen in Indian markets. So where does value lie, and should you still look at growth funds? Mr. Rustagi, thank you so much for joining us today on MF Corner. So let's start with the basics. What is the basis of difference between, say, growth funds and value funds when an investor has to go ahead and invest in one of the categories?
Sonal, I would say both are essentially equity funds. So when you talk about growth fund, these are the funds essentially they invest in companies that have the potential for substantial growth, both in terms of, I would say, business as well as the profitability. So in a way, we can say that the fund manager of a growth fund is looking for growth opportunities for a company and is willing to pay a price for that, because these stocks usually are very expensive in terms of whether you look at PE or look at price to book. The value funds, on the other hand, look to invest in companies that are attractively priced as compared to the fundamentals. So when I talk about fundamentals, I'm basically talking about the intrinsic value of the company, which is based on the financials of the company, the management, how much market share the company has, what is the business strategy. So these are the factors that are looked at. What is the real value of the stocks? Value funds is investing in a company which are cheaper currently as compared to the fundamentals. So in a way, you can say that when you invest in value fund, there is some amount of margin safety. So basically, this is the difference in these two investment styles.
Okay. So, Hemant, we can say that at the same time an investor can invest in both kind of funds here. What's the basis of investment here? Does it suit any type of investor, both of these categories?
Well, I think this is an important question. I mean, there are pros and cons of investing in both growth as well as a value style. Because when you're looking at growth, for example, like I said, they are looking for growth opportunities. Then the value is looking at where the value is. So there is obviously a potential to actually follow a blended approach there. But the thing is that key factor is how much should we invest in value, or how much should we invest in growth. The problem is that when you're investing in the value fund, you can ascertain the level of exposure. But the point is that when you're investing in fund houses that are either following growth strategy or value strategy or a blended approach, it becomes a bit tricky for you to kind of ascertain, how much exposure is there in each of these. So in a way, I think one has to be very careful as far as this aspect is concerned, and there has to be some amount of flexibility in rebalancing the allocation to both these investing style if need be.
Okay. So let's talk about more details here. What are some of the disadvantages or risks associated with both the categories? You did indicate it. If there's any specific that an investor should be aware of if they are wanting to invest here?
Well, yes, like I said, there are pros and cons of investing in both these styles. When we talk about the growth funds, the potential is that these funds can give you much higher returns, especially during the period when the markets are doing well, the economy is very strong. But there are obviously disadvantages that some of the companies may not perform in line with the expectation. So obviously you can have periods of underperformance, right? And if there is a sudden change in the market sentiments, the growth funds impact much more negatively, because you can see higher volatility, you can see a much steeper fall in the NAVs. Similarly, when we talk about the value funds, even though I mentioned earlier that there is a margin of safety, but the fact is that it may take longer for a company to turn around, or for the market to realize that there is a difference in the real value of the company and the price as compared to what is envisaged by the fund manager. So there can be again here periods of underperformance, poor performance. Also, if there is a downturn in the market, there is no protection just because you are investing in a value style fund. You will see the fall. So I think there are disadvantages of investing in both. The key factor, like I mentioned earlier, is to decide, what kind of exposure should you have in these, and have the flexibility of kind of rebalancing.
Okay, all right. We spoke about some of the disadvantages and risks. Somebody who has to invest in either of the categories, how do they identify? Because that idea would be with an expert. If somebody is going for DIY investing, how do they identify growth versus value funds?
But this again, I think, is very important aspect. So when you're investing in a value fund per se, it's easier for you to identify, because if you look at the categories of fund allowed by SEBI for the mutual funds, invest value fund is a category. So if there is a value fund, it has to very clearly spell out that this particular fund, the fund manager is going to follow value investing. So if you're investing in a value fund per se, it's easier for you to identify. It's very difficult to do so in the growth fund, because growth fund is not a strategy. It's an investing style, it's an investment philosophy. So I think there one has to be careful, like I mentioned earlier. There are funds that are following growth, there are funds that are following value, there are funds that are following a blended approach. So I think it becomes a bit tricky. So you need to go beyond and go further deep and figure out what is the philosophy of this fund we are investing in, what is the overall house philosophy of the fund house that you're investing in. And then only you can figure out whether you are actually going for a blended approach or a growth stock. So investing in a value fund per se is easier, but otherwise I think the demarcation is pretty difficult to me.
Oh, okay. That's why we need experts like yourself to make that clearer for the viewers and the investors as well. In that case, somebody has decided, okay, maybe I should invest in a value fund. What kind of investor should really do that? And do you think it's a good time to enter value funds considering that everything in the market has run up?
Well, look, there is still value in certain sectors. For example, look at banking and financial. Within banking and financial, if you look at private sector banks, NBFCs, insurance company, whether it's healthcare, whether it's IT can even be actually contrarian, but consumer cyclical. So I think even within different segments of the market, there are pockets where the value is there, even though the market has run up so much. So in my view, like I said earlier, when you're thinking of investing in a value fund per se, your time horizon has to be longer. The reason being that they can be, sometimes it can be a couple of years or even more for the company to turn around and deliver the kind of result the fund manager is expecting from there. So I think one, you need to obviously make sure that you're investing for a longer period and be prepared of periods of where the performance, you may witness underperformance or poor performance.
Okay, all right. Hemant, you spoke about some of the sectors where you're still finding value, be it the IT space, be it the banking space, healthcare and consumer as well. And we've seen that underperformance coming in from the consumption space and IT space this year itself. But if someone is investing, what should the maximum investment be in value funds? How much should an investor allocate here out of the total corpus, be it the main portfolio or the satellite portfolio?
Well, this again, so I would say a little tricky. As I mentioned earlier, if you're investing in the value fund per se, you can ascertain how much you're investing, right? So as a thumb rule, maybe if you're looking at investing purely in the value fund, maybe 10 to 15%. But like I said, if you're investing across fund houses that are following a blended approach or growth or value, it becomes a bit tricky. That's the reason why I mentioned that one has to be a little careful in terms of allocation there. But it is possible definitely when you're investing in a value fund to decide. And as I said, the thumb rule can be 10 to 15%, but of course, thumb rules do not apply to everyone. One has to look at your own risk profile or the composition of the existing portfolio. If the portfolio is already growth heavy, maybe then the allocation value can be slightly low.
Okay, we take that point. Hemant, we were going to discuss value funds and growth funds only, but you are here and you've been in the industry for so long, and we were speaking to Swaroop about KYC norms as well. What has your experience been? What are your clients saying? Are you also on it day in and day out to solve this issue? What's the industry feedback been on these new KYC norms?
Oh yes, well, absolutely. I think everyone in the company is just doing that right now, honestly. I think the key issue there is the availability of the data. Honestly, for you to figure out, instead of going and checking for each and every one, if the data is available, I think the task can be much easier. And I feel at some stage, there has to be consistency in what is accepted or what is not. Of course, I can understand it's an evolving thing that over a period of time, we'll see different documents required for doing KYC and the manner in which it's done. But I think some amount of consistency can help, and I think availability of data can definitely go a long way in ensuring that we handle it in a much more efficient manner.
Okay. Are NRIs facing more issue than the domestic investors? I'm specifically asking for that because the documentation pool for them is smaller. The passport's not really as helpful here as an Aadhaar would be. So what's your sense here? Do you think there would be some more tweaks required, or do you think that's not a possibility now?
Well, yes. I mean, I would agree that I think it's a little more tricky for the NRIs. So I think some kind of rethinking is required here.
Okay, all right. Rethinking is required here. Hemant, I just wanted to understand one more bit here. What is it at the distributor level right now? Is it more difficult for DIY investors, or is it equally getting difficult for distributors as well to go ahead to their investors or their clients and talk about it?
Well, I certainly feel that, if the distributors are professional and they have set up in place and they've worked properly, I think they will have their own records to look at. They will have the wherewithal to actually kind of help investors through this process. But DIY, I certainly feel that it can be much more complicated. So obviously what we are trying to do is also seeing that if investors still have the capability to invest in the existing fund, if they're not looking at new investment, you can kind of take it a little later. But like I said, you can prioritize and you have the wherewithal and the mechanism to do that. So DIY, I think, can be a little more complicated.
Okay, all right, Hemant, thank you so much for joining us today to not only talk about value versus growth funds, but a situation which is really confusing a lot of investors right now. Where we'll see the progress here, and let's hope everything is sorted out very smoothly very soon. Thanks a lot for joining us today.
Thank you.
Okay, all right, with that, we'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.